Good evening, everybody, and welcome to tonight's webinar on protecting your property portfolio, essential strategies for landlords. This is hosted by Buy-to-Let Scotland in partnership with Caspian Insurance. My name is Laura Havenhand and I am the Partnership Manager here at Caspian, and I'm delighted to open tonight's panel discussion. So I am very aware that most of you will be familiar with Bill McWilliam and Bernadette Cosmale, and we've spent the last year working closely together in order to have landlords such as yourself have access to quality conversations around business and personal protection strategies. So tonight's panel discussion, Bill will be joined by Mike Donohoe. He is the Head of Business Protection here at Caspian Insurance, and between them, they will be sharing a wealth of knowledge and discussing how they are supporting smart entrepreneurs like you safeguard what they're building. They'll be reflecting on changes we've seen in 2025, the impacts and the changes we expect to see in 2026 and beyond. So whether you are just starting out on your journey of buying properties or you've been doing this for years, tonight's session is designed to help you make informed decisions that align with both your business goal and your personal priorities. So I'm going to do a little bit of housekeeping. In the Q&A box that you will be able to see, there is a form you can complete if you would like to organise for one of the Caspian advisors who are experts in this field to speak to you about any of today's topics. If you would benefit from a live transcript during today's session, at the top of your screen, you will see 3 dots with the words more. If you click on that, a drop-down box should appear, and then select language and speech, and then show live captions, and those will be available to you then at the bottom of the screen throughout today's session. For those of you who do have questions tonight, please put those in the Q&A. We actually have some time at the end of today's session designed just to ask specific things that you may find relevant, particularly to yourself, and would like more information on. For those of you who want to recap and go and look at any of the points made today, we will be recording today's session and sending that on to you individually after. Now, just to give you a little bit of background on everybody involved here. So first we have Bill McWilliam. So he, if you weren't aware, is a seasoned pro in this industry, both on a personal and business perspective. He's got over 30 years experience on a personal perspective and 23 years working solely in the buy-to-let market when it comes to mortgages. So he's bringing a lot of experience from working with landlords for decades. We have Bernadette Cosmale, who has 10 years mortgage experience, and she keeps Bill in the right and deals with most of Buy-to-Let Mortgage Scotland's overseas and international clients. She also runs a property investment mentoring programme tailored to Polish clients. We then have Mike from Caspian Insurance. Not only is Mike the head of business protection, but he's also a director of Caspian. He has over 20 years experience in the protection industry, specialised in supporting SMEs, landlords and business owners in reducing exposure to financial risk. And then you have me. My name is Laura Havenhand and I'm the partnership manager here. I have a decade of experience in working closely with financial advisors, understand how protection can play a pivotal role in supporting clients' futures. So I would like to welcome to the screen at this point our panel. We have Bill McWilliam and Michael Donohoe. Welcome.
Evening, everybody.
Good evening.
I would actually like to start today's discussion with yourself, Bill, if that's okay. And start really where you are currently seeing the rental demand in Scotland at the moment.
So in Scotland, unlike a lot of the rest of the UK, the property market is still very strong. In terms of sales, prices in Scotland have gone up on average by 4.5% last year. And here in Edinburgh, we've seen the price of 1 and 2 bedroom flats going up by about almost 3%. One thing about the prices in Edinburgh in terms of sales is very much influenced by the LBTT bands, so that's the bands of stamp duty. So properties under 250,000 are doing a lot better than the rest of the market. In terms of rental, we've seen rents going up by about 9.5% in the past year. So to put that into some sort of perspective, a two-bedroom flat in Edinburgh now, the average rental is about 1,100, and the average rental achieved for a one-bedroom flat is 900. Now that is the rents that are actually being achieved. The ones that are actually being advertised now, a two-bed would probably be about 1,250, 1,300, and a one-bedroom around 1,000. What I found personally with my own portfolio is that the demand for one-bedroom flats is extremely strong still. There's a slight sort of price cap around £1,000, but anything under £1,000 does very, very well. It's a wee bit tougher for two-bedroom flats now, just because the price of them is a bit more expensive. Another thing that we've seen over the past sort of 6 months to a year is there's a lot less international people look to rent properties, certainly in Edinburgh. That could possibly be because of Brexit. It could be because the income potential in Scotland now is less than it was a couple of years ago. A lot of you will remember that 2 years ago, you'd have queues of people trying to rent flats, with people basically fighting to get onto tenancy agreement. Unfortunately, that's no longer the case. To be honest, that period in time was a bit unique. There was various things that I think contributed to that. Obviously, we were post-COVID, and there was also the rental freeze in Scotland. So that, basically inflated the market to a sort of unrealistic level. Unfortunately, now we are sort of back to normality, but overall, the rental demand is still strong.
And to be fair, I think the one thing that I know there's, south of Edinburgh, and it's very regionalised. So how the market is performing, it's due to economic factors, just based on exactly where you are. And I think this is where this is so useful, because this is exactly the market that we're talking to. These are the things that are going to be the most useful. I think when you're looking at these things, I think the attitude and this snapshot to the market, I think it'd be useful, Mike, for you just to say from a protection perspective, bearing that in mind, what are the attitudes are you seeing when you're looking at landlords and with this buyer's market?
Evening, everybody. So if you kind of look back over the last, I don't know, 5 years or so, obviously we've seen a huge shift from privately owned, individually owned properties into the limited company. From a protection perspective, very much, and by protection here we mean life insurance, protecting that risk, the debt and the liability that's in the portfolio. My experience of dealing with and talking to landlords over the last sort of 5 years or so in this market has been they're very much in two camps. So you've got those that are not comfortable, like myself, very risk averse. I'm not carrying this debt. I want it protected. Full stop. I want the insurance. If something happens to me, I don't want that debt passing down the generation. And then you've also on the far extreme to that, on the other side, you've got those that are, building equity, building asset value into their portfolio that are quite happy to carry that risk. And I think where there is a real gap and opportunity for us all are those in the middle. So they aren't quite in either of those camps, but do want to have a conversation about the opportunities and the options that are available to them. And that's where we've generally been focusing, because if people are happy with carrying that debt, carrying that liability, passing that on, that's fine, no problem. But make an informed decision is all I would say. Have the conversation, understand, speak to a specialist, understand what's available to you. And, once you've done that, you're in your own position to make that decision.
Absolutely. And I think so many people think they understand it until they actually speak to a specialist, and then they realise actually there's so many ways it can help. I think there are a lot of pressures for landlords and so many spinning plates, things that they need to be considering in order to make themselves ready for the future. And one of the impacts that will come up time and time again is things like changes to legislation. So going into Bill 2026, is this a concern for landlords? And what are we looking at going forward? What do you anticipate?
I suppose legislation always is a concern for landlords. At the moment, the main bit of legislation that is being talked about probably most is a change to EPCs, energy performance certificates. So from the end of October of this year, there's a new form of EPC being rolled out. So from 2026, EPCs will only be valid for 5 years instead of 10 years. Um, Now, for the time being, it doesn't mean that you need to change your EPCs, but when your current ones expire, you will need to get the new form of EPC, which will last for 5 years.
Mhm.
The other thing that is being proposed is that by the end of 2028, every rental property will need to have an EPC of C or better before it can be let out. Now, um, you've got to remember that there is also a Scottish election coming up this year. So again, this may change. I think the fact that the new PCs will be rolled out in October is definitely happening. As for the proposed minimum of C, it's a wee bit up in the air. It depends on who gets into power. Other concerns are proposal from the Scottish Government or the current Scottish Government of rent caps and putting limits on rent rises.
Mhm.
But my personal feeling is that, I've been renting out properties now for over 30 years, and this sort of proposal has been bandied about for all of that time. And I'm quite sure if we were here in 10 years' time, it will still be being talked about. One thing
Mhm.
about, things like rent caps and limiting rents is it's very hard to actually enforce in
Okay.
a fair way. My personal view is basically, don't really worry about these things until they happen. I think it's very unlikely, and if they will happen, it's going to be a long way off.
Okay, so when you take those into consideration, so my understanding is that if they did happen, that will potentially mean people need to do improvements potentially to stay in line with the EPC. Is that right?
That's correct, yes. If EPCs have to go to level C, then um, a lot of people will have to improve their property to get up to that level. Um, Now, anyone who's got properties that are listed buildings, I know there's likely to be exemptions for things like that. But for most lands, it would mean improving the buildings to some degree.
Okay, so I think those sorts of things. I mean, I think that's probably why it makes people nervous, isn't it? Because anything which is going to need cash buffers, some further investment, those sorts of things, you need to raise those funds in it, and therefore it makes it incredibly important when you potentially are going to have to look at periods of organising upgrades, and you may be very hands-on and want to do it yourself and rely on family members and things. I think protection can support certainly when it comes to business liquidity in so many circumstances for people who have these sorts of things when they could come around the corner. Mike, in your experience, what are the ways that a business could support liquidity through protection?
There's lots of different ways. So obviously, my first kind of note on this would be if there is anybody in the audience that does have any life insurance or critical illness income protection, whatever it might be, any protection in place, and it isn't structured correctly and it isn't being funded by the business and it isn't being paid for correctly outside of their estate, etc., then obviously please get in touch because that is crucial that you get that done, set up correctly, done properly. Um, in terms of business liquidity, portfolio size plays a huge part in this. So obviously in the smaller portfolios, you're going to have very little cash, very little room. Should the worst happen, that portfolio passes down as an asset, which is great. But moving forward, fast forward, 2 years, if people are putting large chunks into their pension, or the businesses are operating as an income outcome business, then they could potentially fall into people's estates as well. So having the right protection in place will enable you to do two things. It will enable, from a business perspective, it will enable you to have time. So you won't have to make any rush decisions. You won't have to, like Bill said, you don't want to be selling properties at a time when the market's against you, because you're going to lose significant value. So it will buy you time, and it will also provide cash. Now, the way that we structure these policies is that the money's kept outside of the business. It's kept outside of your personal estate. It will be wrapped into a trust, a specific trust, which means everything else can be dealt with in time. There's no pressure. That portfolio can continue as it is. You don't need to, have concerns from lenders, that type of thing. But what you will have is cash. And do you need enough to cover your whole borrowing in your portfolio? That's up to you. But cash on death will buy you time, and it will buy you peace of mind.
Yeah, and I think that it absolutely is to be said. It can't be underrated. I think just knowing that your family will be okay, and that takes one worry off them at least. I think from a personal perspective, I've been in the position where that protection wasn't in place, and it did have its implications, and it did put an awful lot of pressure. And so for me, I was quite a young person at 20, but actually no one has spoken to my mum about what she could put in place. And you live, you learn, and that's probably why I'm very passionate about these things, for people to at least look at what they can do. In regards to the mortgage market, if we can move there, Bill, what do you see changing in the next year?
Well, the mortgage market and the banks that are involved in the mortgage market, I suppose, are a bit like oil tankers, that they change direction very, very slowly. Going back again a year, maybe 18 months, I think we all expected, or certainly hoped, that interest rates would drop rapidly. That hasn't really happened. Interest rates have gone down, but it's been a fairly slow process. Very roughly in the buy-to-let market, interest rates are about 1% down where they were a year ago. So a buy-to-let mortgage for a limited company, 5-year fix, would probably now be coming in at about 5%. And that's, a mortgage with no fees. But what we have seen changing is the banks have become a lot more flexible. So there are lenders now that will do 80 or even 85% loan to value on rental properties, which is quite a big step forward. Also, banks are being a bit more flexible in things like non-standard construction nowadays, types of properties. I had a client just recently who was buying a non-standard construction property above commercial in a high rise. And we got that approved by one of the high street banks, and that was on limited company buy to let. So there is a sort of change, and lenders are being a bit more flexible. There's also things like there's more fees-free refinancing available for limited companies now. So in the past, if you want to refinance your limited company property, you would need to pay legal fees, pay valuation fees. There's not a lot of lenders, but there are some now that are giving assisted or free legal fees and free valuations to limited companies. So again, that is a bit of a step forward.
And it almost feels like then they're encouraging.
Yeah, I mean, they are becoming, they see the limited company part of the market as being where the growth, is. If they want to grow, that's one area they need to go to. So they are improving their products. I was actually part of a focus group at the end of last year with TMW, and TMW want to increase their presence in the limited company buy-to-let market. And they asked various brokers about how they felt, how we felt that they should do that. As usual, when you speak to lenders, you say, well, this is, you need to do X, Y, and Z. And they say, oh, yes, but policy says we can't do this and we can't do that. And you say, well, if you want to move forward, that's what you've got to do. But they have, things like flexibility on non-standard construction, the free legal fees. These are things they took on board and are offering now.
Mm-hmm. And so
There's other,
do you think
oh,
that's
sorry.
making, oh, sorry, I was just going to say, do you think it's making landlords therefore more confident to start looking at expanding their portfolios?
I think it is, yes. Yeah, I think, and also, be a bit more creative in what they do with their portfolio. And the
Mhm.
fact that they can raise money a lot more easily in a limited company now than they could 2 or 3 years ago. So it made quite a big difference. Other lenders have also got products. For example, there's now refurb to let products. So basically, if you buy a property that's not in a habitable condition or not fit for
Okay.
letting, then you can get a loan on that property, do it up, and on day one, the valuer will tell you what that property is going to be worth once the work's done. And as long as you do up to the standard they expect, you know,
Okay.
they almost guarantee that's the valuation at the end. Another thing that we are seeing is there are new lenders coming into the market. There's quite a lot, particularly in Scotland, because there's a lot of lenders that are around in England that we don't or we haven't had in the past. So we are getting new lenders. There's West One, HDB are examples. To be quite
Mm.
honest, it's the same, it's the same stew heated up in a different way. It's they're not really offering anything new. They claim they are, but
Mhm.
my experience is they're not really doing a great deal that's new. But yeah, in its own sort of slow way, the mortgage market, particularly for limited company buy-to-lets, is improving, and it's becoming a little bit more dynamic.
To be fair, I think it's been probably needed a little bit as well. If you had to put your hat on it, what would you, well, actually, I'll rephrase that. When would you recommend someone does a 2-year fixed rate and when someone should look at a 5-year fixed rate mortgage? And how do you help people come to that decision?
Well, I suppose partly because the whole point of this seminar is about people protecting their assets and protecting their portfolio. So for security, I would say go for a 5-year fixed.
Mhm.
The reason for that is if you buy a property today and for whatever reason, and when it does happen, it's always unexpected, the property market, takes a downturn. So if you buy a
Mhm.
property today, the property market takes a downturn. If you've got a 5-year fixed, you've got 4 years for that property to improve in value. Um, I got caught of it myself back in 2008 because I had properties on 2-year fixed. The market collapsed, and when they came up to refinancing, I couldn't refinance them because they weren't worth what they were worth when I bought
Okay.
them, and I didn't have the money to put in to reduce the loan amount. So
Mhm.
for security, I would say definitely go for a 5-year fix because it does give you the opportunity, if things do go bad, that it can recover. If you
Yeah.
buy a property and you are very confident that either A, you bought it cheaply, or B, you can improve the value quite quickly, then go for a 2-year refinance. But I'd say generally try and go for 5 years.
Yeah. So whilst you were saying that, I was just thinking that actually, if someone goes for a 2-year or a 5-year, that really gives a very good indication of their risk appetite when it comes to taking out that mortgage and potentially looking at protection. And so this, Mike, actually is where I'd like to tee over to you because I think that probably is a good place to explain what you would think on that matter.
Well, I'm in the 5-year fixed rate camp, Mr. Risk Averse over here. But something we've been working on with landlords in the last sort of 12 months or so has been around let's break the portfolio into pots. So my concept of this is we have an equity pot, we have an asset pot. Now, something Bill said there was interesting about the 85% LTVs now. That doesn't leave you a huge amount. It's a great thing for getting more people into the industry, into the market. But risk-wise, it doesn't leave you much room for error if something happens. So break your portfolio down. Have a think about the size of your individual portfolios now, and how much have you got in that portfolio that is an asset, that is effectively equity, and how much have you got that's borrowing? And then break that borrowing into half and go, if I cover half of that, that gives me a third pot that's protected, that's insured. And by doing that, you're taking all the pressure off the portfolio, off your family, off yourself, even though, we're protecting this. But financially, if the worst was to happen, you have cash available and you're protecting the value, the asset value in your portfolio. You're not going to have to make any rush decisions. You're not going to have to sell properties. But by having that third pot available, it gives you not just liquidity, as I talked about before, but it gives you stability, both personally and as the owner of the portfolio. So, like I said, it's very much about attitudes to risk. We talk about insuring it if you pass away, but there are other things you can do. If you're drawing income from the property, then there's options we can do to protect you from a health perspective, or whether that would be putting your private healthcare through the business. There's lots of different things that people won't know are legitimate business expenses you can offset. But risk is definitely the starting point. What I always talk about with landlords and owners of limited companies with portfolios is, okay, tell me about your attitude to risk. And it's usually, like I said, one end or the other. But I think if I put myself in that position for a second, I'd probably be on the middle to top end of I don't want the risk. But understanding that everybody's different, every portfolio size is different, everyone's house values. We talked about regional stuff before. All these things play a part. So, if you want any advice on this, it needs to be about your own circumstances.
Yeah, and I think conversely, I remember an investment manager of mine telling me I had the highest risk appetite ever. So we are completely yin and yang in that regard. It doesn't surprise me. Um, I think when you're juggling all these different elements, and if you have got like I know I do have this high risk appetite, and you do want that 2-year fixed, and you are going to be going at it hell for leather to get everything done. I think, it's just the smallest thing, and well, a relatively small thing. If you just can't do the work and you need to bring someone in, then that completely scuppers the plan of getting everything done to increase the value of that property on that timeline. And that's an underpin that protection can give people. Like, for me, that'd be incredibly important, because I know I'd be putting myself under an awful lot of pressure in order to deliver in that time frame. And illness strikes, doesn't it? It comes around the corner.
It does.
I think something that I learned from you, Bill, and I wasn't aware about it, because I think it's very specific to the Scottish market, was around ADS. And it'd be really, really helpful, I think, for people tuning in tonight, just to explain, like you did to me, how it might affect a portfolio strategy or tax positioning might evolve over the next few years.
Yeah, so well, where I had to describe ADS to you is mainly from the perspective that it's something that's unique to Scotland. So south of the border, people who buy properties have got to pay stamp duty. In Scotland, we have to pay LBTT, which is Land and Building Transaction Tax, which everyone has to pay on a property over 145,000. But if you're buying a second property, whether to live in yourself or it's for rental, you have got to pay ADS, Additional Dwelling Supplement. Now, one of the reasons that we originally planned this meeting for this time in the year is because we want to get the budget out of the way, because there may have been changes to ADS or to tax. The good news is there wasn't any, so ADS has stayed the same. However, it is still extremely high. It is 8%. So it is a painful expense for somebody buying properties. the way that a lot of people are getting around that, there's two ways that they're either getting around it or minimizing it. A lot of people are now buying portfolios. So if you buy a portfolio of 6 or more properties from one individual, then because that is termed a commercial linked transaction, then it is exempt from LBTT and ADS. And instead you pay commercial stamp duty, which is considerably less. Another thing we see a lot of our clients doing, particularly younger investors, is that they're buying properties that need work done to them. So rather than buying properties that are all in really good condition, and having to pay the ADS on the higher purchase price, they're buying properties which are lower in value, they pay the lower ADS and increase the value by doing work on the property, but it's saving tax in the long run. The other thing that you can do if you're really ambitious is if you can buy properties under £40,000, then you don't pay ADS at all. Finding these properties in areas that are suitable for rental is a challenge in itself. But we do see people doing that they are buying properties below £40,000, doing work on them and then refinancing them at, say, £65,000, £70,000 once the work's done. Another thing, again, you can do, a few of our clients do this, but not a great many, is buy really distressed properties. So if a property is deemed to be uninhabitable, it's there's no defined definition of what uninhabitable means. But if, for example, it's got no roof, then it's exempt from ADS. If it needs a new kitchen, well, that wouldn't qualify. But so that's what we see happening in the ADS side. In terms of for individuals with properties, over the past, I think we're up to 7 or 8 years now, the government have continually reduced the amount of tax exemption you can get from mortgage interest. So people owning properties in their own names are having to pay considerably more tax than they did 8 years ago. A lot of portfolio landlords have been doing over the past few years, and it's something that we're quite involved in, is moving their properties from their own name into a limited company. And by doing that, there's an enormous tax saving. And there's various things you can do. When you do that transaction, the equity in the property generally goes over as a director's loan. So you can take money out of the business until that director's loan is used up and not pay any tax in it. So that's sort of thing that we see people doing, to try and mitigate against tax.
That's interesting, because, I think one of the things that people don't actually realise is with a director's loan, it would actually have to be paid back to the estate immediately, wouldn't it, Mike, upon someone's death? Go on, I could tell you were eager to say something then. You take over.
It does, yeah, you do have to pay it back, but it's in terms of priorities, depending on how it's been set up in the business type, quite often it can fall quite far down the pecking order. The HMRC get paid before anybody. That's pretty much a fact of life. So, having been it, if you're the director loans, really smart move for a lot of people. The problem is that if a business starts to struggle, getting that back can be quite difficult. So if you've got a small portfolio and you have to sell it, that can cause you problems. So having that as a strategy is a good idea if you back it up.
Well, I totally agree. I was just thinking, yeah, no, I really do agree with that as a sentiment. So sorry to do a little curveball, but just back to what we were talking about, Bill. There's some key changes coming into play for landlords, and obviously we've just gone through some of them, but I think they form how reforms are influencing how landlords now choose to buy and hold those properties, which you touched on, because it's changing what they're doing, isn't it?
Yeah, again, over the past few years, the biggest change is the fact that there is very few people nowadays who are looking to invest in property, buying properties in their own name. Um, most of our clients are buying in limited companies, and those that did hold properties in their own names are transferring them now into a limited company to reduce the tax. Um, I think there was again, it's one of these things that was banked about a few years ago about the number of landlords in the UK, and I can't remember what the number was, but they were saying that 90% of landlords in the UK actually own less than 5 properties. That's certainly not the case now. Most of these landlords that have small portfolios and didn't have any real ambition to grow the portfolio have exited the market. And most people that we see in the market now, they are sort of professional landlords. They want to build large portfolios. And really, building large portfolios is the only way really to make money in this business now. You've got to really do it on a sort of professional level.
And I assume there will be some kind of cost appropriate and attributed to doing that. And
Well, yeah. So if you're buying a limited company, there's various costs. So it's a bit more expensive than it used to be in your own name. The fact you've got a limited company means you've got to basically get an accountant to do your accounts. Um, you've got to get finance as a limited company, which is more expensive than for an individual. For people that are transferring properties across from their own names to limited companies, um, there are a lot of costs that can be involved with that. However, quite a few of these can be mitigated against. So, for example, if you are moving properties to a limited company, that is viewed by HMRC as a sale. So you're selling the properties to a limited company, to your limited company. So therefore, the limited company should be paying LBTT and ADS.
okay.
But as I said earlier, if you're transferring more than 6 properties, then you become exempt from the ADS, exempt from the LBTT, and you pay commercial stamp duty. So that's a lot less. The other thing that you would normally have to pay would be capital gains tax. So if you buy properties and they're doubled in value and then you sell them to a limited company, you would be liable for capital gains tax. However, there are, depending on your situation, there's 2 ways to avoid that, or certainly to defer that. One is if you own the properties jointly with somebody else, so it could be your spouse or it could be just a business partner, then if you're transferring from a partnership to a limited company, then you can do that without paying the capital gains tax, as long as you prove to some degree that you are running this as a business. So if you are, I don't know, if you're a city banker or you are a GP and you're working 6 hours a week, you can't legitimately say, well, yes, but I run a property business. But if it's a major part of your income, then you can legitimately say, this is my business, this is my income, and you can get the exemption from the capital gains tax. But if you don't qualify for that, in some cases, not all cases, but some cases, what you can do instead is defer the capital gains tax. So you transfer the properties across, you declare how much capital gains tax that you are due to pay, but then you can defer that to the point where you sell the properties in the future. So if there's £100,000 of capital gains to pay, then you can defer that, and when you sell the properties, you then pay the capital gains that's relevant for that property. Other costs that are involved, because you are buying and selling property, there's a legal process you need to go through. It's simplified quite a bit because it's basically the same individual doing both sides of the transactions. That does simplify it, but there is a cost there. And if you've got mortgage on the properties, there may be things like redemption penalties on the mortgage that have to be paid. So I can't define how much it would cost, but there is a cost for doing it. But a lot of these costs can be mitigated against.
Yeah, it's really interesting. I think I think, gosh, it gets incredibly nuanced, doesn't it, once you start scratching the surface? And this is why you are the expert. I think obviously it's so evident through everything that we've said tonight that the market is moving people to grow their portfolios, minimum 6, and then you can be exempt from this. So there's obviously a real desire that's underpinning this to grow this market somewhere. And the fact that the shift to limited companies, I think when people start looking at portfolios as an actual legitimate business, I think this is where looking at their protection strategies can really come into its own, Mike. I think it when you look at a business, you have to look at all the places where it could fall or fail, and where those key areas of weakness are, and how protection can support you. I think it'd be really helpful if you went into some of those, Mike.
Yeah, sure. I mean, I guess the interesting one that Bill touched on there is what do you do with limited companies that have business partners in them that aren't related? That's a big area that you effectively, if you own that business equally 50-50, then 50% of those assets, the value will leave the business if one of you to pass away. So where are you finding the cash to get that asset back into the business, get those shares back into the business? Something that if you are in the position and you're in the audience that you have a partner with your portfolio, definitely worth a conversation about how you can offset that as a solution. And again, if we talk about the bigger portfolios, it's about, if this is your income, if this is your, livelihood, or this is your full-time job, then, there are things we can do to make sure that the business operates. Forget the property side of it for a second, the operational mechanics of the business can survive without you in it. And more importantly, from an income perspective, so can you. So there's lots of different things to think about. Like Bill said before, something about the additional costs and not being able to put a price on it. I think that's where we can help in terms of we can give you one back effectively from the HMRC. So everything that we do, you will be able to offset against your corporation tax, against your own personal earnings. It will come straight from the business. So lots of different things. It just depends. Like I said, everybody's circumstances are different.
Well, and I think that's the thing, isn't it? It's always going to be unique, and generally, well, in this scenario, we have to generalize somewhat a little bit just to try and cover all the bases. Do you feel, Bill, that there's an area where it's a priority from a property portfolio to protect it?
Yeah, I think because the way that the market's sort of going, and the fact that if you are investing in property and you are a landlord, you now have to do it on a larger scale than was required before to make it worthwhile. Then there's lots of things you've got to put in place that people didn't really have to consider before. So for example, you need to have, to some degree, a sort of management team behind you. Whether that is somebody to help manage letting out the properties, somebody to help with maintenance, things like that. But you really need to have a sort of proper management team behind you. Also, you need to have, in effect, a locum in place. So if anything did happen to you, then they can step in and basically, take the phone calls, take over the business, if you're not there. And, as Mike has been saying, you also need protection on that business, because if something happens, particularly to your health, then you need to make sure the business is secure, and those that need the business to survive are going to be secure.
Yeah, Absolutely. I am actually just going to ask this question that I saw come up because I think it's relevant to where we are at this moment. What defines a small, medium, or large buy-to-let portfolio?
Um, um,
I'm genuinely curious. I've never thought of this
yeah.
question.
Well, I suppose it's one of these. I think, it's one of these things. It's sort of, in a way, it's all relative, and it can also vary. So, in terms of our own clients, um, I would say now, in the past, a small portfolio was maybe five or less properties, and now a small portfolio is probably anything less than 10. 10 up to 25 to 30 is a sort of medium portfolio, and anything larger than that is a large portfolio. Um, some of our clients have got into the hundreds up to almost 400 properties. So they are exceptionally large portfolios. Um, there's other clients that we have whose portfolios are smaller in terms of number of properties, but they're higher in terms of value. An Edinburgh portfolio of HMO properties may be, you know, 80, 80 properties, but that could be worth, you know, best part of 6 million.
Wow.
So, 60 million, it's a huge amount of money.
Mm.
Um, but
And I
I
would
would,
assume most of those are interest-only mortgages as well in a vast
in,
majority.
in most cases, yes. Um, One of the reasons for the interest only side is that you can, in a limited company, you can claim the tax against the against your sorry, you can't claim the interest against your tax.
Mhm.
So it becomes almost self-defeating to pay down the interest
Okay,
because pay down the capital because you're paying more tax.
interesting. So I think it comes back to when you have, Mike was saying earlier about these pots. So you have your equity, you need something probably to help if something happens for huge liabilities, just at least some of it to be in place and having that little bit of security. Um, I think I think tonight's been incredibly informative. I think you've both really gone into quite a lot of detail. Um, and there's so many things that we've covered off. I know I've personally learned an awful lot. Mike, I would actually like to ask you if anybody did want to look at the journey. So we've alluded to the fact that it's always bespoke. It's always going to be different depending on every individual. But how do you differentiate? How does that look? How do we look into these things for people?
So obviously we've had these conversations with a number of clients recently from Bale and Bernadetta. I think for us, our process from an advice perspective is introduction and fact find, and that's about it. And what I mean by that is we ask the questions, we understand the individuals, not just the portfolio. We understand their own individual circumstances, their own financial security, their own risks, and and talk to them and educate them about, are you covered if this happens? How much you put in your pension? These types of things, so that we know that that individual is financially secure. And if they're not, then we've got solutions to help you from an individual and a business perspective. But our first, our general advice process will be introduction and fact find. If there's any opportunities for a solution at that point, it will be email. You will always let people to have a bit of time to think about it, talk to the others involved, talk to the family, etc. And we follow up, and then at that point, you're in a position where you can make an educated decision. And that's our job. Our job is to educate and advise. And if you understand the risks, you've had the conversation and you decide against it, well, that's that's your prerogative. And if you if you do, then you know, I hope you live forever.
What's it they say? There's nothing, the only things that are certain is death and taxes.
Certainly seems it from this conversation tonight. Absolutely, yeah.
It's never felt more appropriate as a sentence. We've got a question from our attendees from Hanif. So he's thanked you, Bill, said it's been very informative. And he has a question about moving assets in the limited company. If you sell your portfolio to the limited company, but get the relief, which allows you to avoid paying the CGT until such time that the limited company disposes of the asset, can I just confirm if using this relief, you would then need to sacrifice the equity and no longer treat the equity as director's loan? Did you follow that, or do you need to take it offline?
I'm not really sure I can fully answer that question, Hanif, unfortunately. Partly because getting into too much depth about the tax side is really out of my realm of expertise, so I can't really give tax advice. So when you transfer properties into a limited company, you have the choice of either gifting the equity to the limited company or putting in as director's loan, which you can then withdraw. Now, how that works from your personal tax perspective, you would really need to check with an accountant, which is most beneficial for you. I think it would depend on what you want or need to get out of the portfolio. So if you need to get an income out of it, then you wouldn't gift the equity, but you'd really need to check that with an accountant.
Perfect, thank you. So those were the questions from our attendees, but I actually do have a question for Mike, because I do. And I know I've asked questions all night already, but for me, I think it'd be really, really helpful. So, for example, if I was 30 years of age, which I wish I still was, and I know this is something I discussed with Bill previously, the priorities really shift between a 70-year-old and a 30-year-old on what we would consider looking at. I wish it was 30, I'm just going to say. And I think there's key differences in how we even approach the conversation, because we understand that somebody with a £60 million worth of assets potentially is very different to someone starting out with 3 properties at 30. What would you say would be the kind of areas where we would typically consider in those different dynamics?
Again, it goes back to individual circumstances. So if somebody is if somebody's just starting out, it's what are they doing elsewhere, in terms of income, in terms of occupation, in terms of lifestyle, and as the portfolio grows, then their risk exposure and their need for protection will evolve as well. When you're young and healthy and you've got a long time to retirement, your biggest asset is your income. But as you build that and you build your asset value, you build your estate value, you build your pension pot, your income is still important, but less so as you approach retirement. So yeah, size portfolios does play a factor, but also as does where people are on their journey of life.
Thank you. I've got a question from Norbert. Bill, this is for you. Bill said something about the interest being tax deductible if the property is owned by a limited company. Could you clarify, please?
Yeah, hi Norbert. Yes, so if you own your properties in your own personal name, then when you do your tax return, you've got your rental income, you've got your expenses for things like repairs, which get deducted from that, and you then have to pay tax on the rest. So even though you're paying an amount of money as interest, you then don't get tax relief immediately on that. what HMRC do is they then give you a proportionate amount back, but that is related to how much you personally earn. Basically, whether you're a lower rate taxpayer or a higher rate taxpayer. If you transfer your property into a limited company, then when you do your tax return for the company, you've got your rental income, you deduct your expenses in the same way, but then you can deduct the interest paid on your mortgages. And then once you get that deducted, you get down to a net figure, and that's what you pay tax on. So it would be considerably lower than it would be if you had your properties as an individual, assuming you're a higher rate taxpayer.
Okay.
And now, the other thing just to add to that is because when you do your tax return, you are using your gross rental, then it is very easy to become a higher rate taxpayer. So say you have got 4 properties making £1,000 a month in rental, and assume there's no deductions for maintenance, you are instantly a higher rate taxpayer before you make a penny from your day job.
Okay. Okay. Not great then.
No. I mean, that's why people are transferring the properties across limited companies, because it is, it is that bad.
Okay. I'm going to do the last question now. This is for Mike, just I'm mindful of time. And it might be one that we need to pick up separately, but I'll see how you get on. So earlier you mentioned that people might have set improperly up their policies, life policies, and they should be checked over. If the insurance is taken for the director of the limited company, how could I learn if my policies are set up properly?
Thanks very much, Wojciech, for the question. Simple simple way to do it. Send it to me and I'll tell you in 10 seconds. Yeah, by all means, yeah, I can tell you very quickly if everything's set up correctly, not just with the policy, but also with potentially what would happen on claim stage. So it's not just the setup at when you do the policy, it's what would happen if the worst were to happen, making sure everything's done absolutely correctly.
Thank you. He does have a second question, but I'm very mindful of time. Do you want to give it a go?
In terms of, yeah, your sum assured, it does vary. I think, have a chat with us, Wojciech, for 10 minutes and we'll give you some advice and you can go away and have a look at a few options, probably is the best way to do it.
Thank you. Well, I think at this point we will wrap up, and thank you, whoever's telling me I've done a good job. Thank you very much. I just want to say a huge thank you to both of you on a Friday evening, being here, to everybody who has attended. Hopefully this has turned out to be your Friday night takeaway of knowledge and given you lots of things to think about over this weekend. The link is in the question and answers Q&A box. So if you would like to book a call with us, feel free to do so. I'm just going to bob that back in now for anybody. It's right at the beginning. And well, it's been a pleasure. Thank you so much, Bill and Bernadette, for having us. And I hope everybody has a really lovely evening. Personally, I am probably going to get a nice glass of wine now, and I hope everybody else is doing something similar.
Thank you, Laura. That was great. And thanks everyone for joining.
Thank you
very
so
much, everyone.
much. Thank you. Bye-bye.
Bye.